let's start quickly with what this chapter about and what's the incremental analysis for. The incremental analysis, again, is going to help us to make decisions when we have to make a choice. The choices are between should I accept a special order, should I not? Should I make or should I buy component or parts for a finished product? Should I sell the product or process it further? Should I retain or replace the equipment? That's more like a capital decision. Eliminate or retain unprofitable business segment and allocate the limited resources. In class, we already went through the special order. So now what I want you to do is for every incremental analysis. Now, what you can do is get yourself an Excel spreadsheet and see, accept the special, an order special price. And have in mind the decision criteria. What's the decision criteria here? The special order is accepted if the contribution margin or income is positive. So when the contribution margin is going to increase the income, when you cover the fixed cost. So what you have to know here is what you have to make yourself a note, as long as the sales price is more than the variable cost, you can generate contribution margin. That's the only way, the contribution margin to be more than zero. That's what you have to chase here. That's what you have in mind. So as long as the sales price covers the variable cost, you're okay with the special order. And again, make sure that the company has capacity. Again, the key assumptions here is that the sales company order will not affect the special order. Customer will not know about it. And we're going to continue within the relevant range, means that the company doesn't operate in the full capacity. Make sense? Once you have those things in mind, and once you know the decision criteria, then everything is easy. Get the information, figure out where the variable cost is, figure out where the proposed price from the customer is, how much he's willing to pay. Compare those two. If you're generating contribution margin, go for it. Now on the Pearson, sorry, not Pearson, no, Wiley. In Wiley, you have to follow this format. For those of you who already attempt this type of question on Wiley assignment, you already saw that this format will be waiting for you. We're going to cover more of this format a little bit later. So now, and this is the question. Do we have to do this question again? Or you're good?
Professor again.
Again? Okay,
Yeah.
then grab it here. And let's move it to the Excel spreadsheet. And let's work on it on the Excel spreadsheet. Just give me a second to move it to the Excel spreadsheet. And we can do it there. I need one more thing to grab. This one. That's even better here. Just a second, I'll share my screen. Just in a second, just give me a second. One more second, and I'm ready to go. Okay, stop sharing this and share the other one. This one. Okay, here we go. That's our question. That's our Excel spreadsheet here. This company has capacity. So what's our capacity? Can you see the capacity?
Yes.
How much is our capacity?
200,000.
200,000 is our capacity. Now the question is, do we have capacity and where we are on the capacity side? So currently, we are on 175,000. So do we have extra capacity?
Yes.
We are not, the capacity is not our problem. We have the capacity. In fact, we have exactly 25,000 to produce. The customer comes and say, can you produce me 15? So that will be the new customer. He asking for 15,000. Can we make it
Yes.
without changing our fixed cost? Yes, we can. Now, what else it also says? What will be the purchase price? And he asking for new sales price. Uh, 105. Our regular sales price is more than that, right? Our regular price, where we can make it, let's keep this one here, and our regular price is regular sales price. In this case is exactly 1.55, correct?
Yes, sir.
Okay, so what's important for us to know and what to know? So the currently sales price will not be affected for the sales order, and the variable marketing cost will not be incurred in this special order. So we're chasing. So that means out of these costs, so in the normal operating cycle of the company, this is what we get. This will be what we're gonna have if the company working normal and everything is in the normal course of business. This will be our structure. We're gonna have this 55 $1.55 $1.55 regular price, and the customer is gonna come and is gonna have 0.35 is this one, 0.075 is this one, and 0.25 is that one. Now the question is, are we generating contribution margin here? And how much is our contribution margin? Can you tell me? That will be equal to this one minus this one minus this one and minus that one, correct?
Yes.
So our contribution margin in the normal cycle is 88 cents. Now the question is, with the special price that this customer comes, can we generate contribution margin? Well, what's gonna stay, what's gonna go?
No variable marketing.
So prime cost gonna stay, right?
Yes.
Variable manufacturing overhead is gonna
Yes.
stay. Variable marketing,
No.
gone. That will be zero. Are we generating contribution margin?
Yes.
Looks like it, right? So, but how many units we selling? 15,000?
15,000 units.
So if we sell 15,000, how much is our total contribution margin in this case? This one time 15,000, and you're getting the number. So what's gonna happen? Our operating income we expect to go with that amount. Make sense?
Yes.
Everybody understand this?
Yes, I see.
All right, awesome. So this will be the normal course of action. This will be the special price. If we have this special price. Okay, and that will be question one. Okay, let's go back to the slides. And our income is going to increase with $9,375. Now, the next thing that we have to do was what we started in the class was make versus buy. Should I make it at home or should I buy from outside? Should I make it internally or should I buy it outside? Like decision criteria here is we'll outsource or we're gonna buy out only and only if the total cost saving is positive. Now we have to look at the cost, not only the sales price. Advantages, those advantages, disadvantages. I strongly recommend you to pay attention to advantages, disadvantages, because most likely that will be that's what I'll be looking for from you when the actual quiz comes. Make sense?
Yes.
I want you to know what the advantages, disadvantages are and how to explain them. Now we have this situation here. So where was that? Here, the situation, and we did this in class. I'm not going to spend time on this. However, let's go to the question now. And we saw the opportunity cost. Don't dismiss the opportunity cost. Sometimes it looks like, I mean, obviously, it's more beneficial to make it inside because you're going to save $25,000. If you buy it outside, you have to pay $25,000 more. However, now when you don't make it inside, you free in the capacity. The question is, can you do something about that capacity? If you can generate from the release capacity 38,000 income, that's going to be enough to cover your loss of 25 and give you another $13,000 positive. So in that case, clearly go and do it. We did this in class. Let's go with this. That's where we stop, correct? Let's do this together now. Again, I'm going to flip this in the Excel spreadsheet. Just give me a second to go to the Excel spreadsheet and to make it prepared for you, and we can move there. Actually, there are two parts. It will come. Okay, that's the one part. This is the second part that I need. In this case, we're not chasing capacity. No more capacity is needed. However, we're going to chase different things. Let's see now what exactly we're going to need. Stop sharing this and move to the Excel spreadsheet and show you the question. This is our questions. Can you guys see it? And this is our information. Can you guys see it?
Yes.
Awesome. So, how are we going to do this? Well, let's do it our way, and then we're going to try to flip it on the Wiley way, and you can do it in the Wiley way. First, we're talking about here 1,000 units, right? Manufacturer uses the several of intended modules monthly per production cost. The monthly per unit production cost for 1,000 units. Now, the units that we're chasing is 1,000 units. That's what we're chasing, units. 1,000 units is estimated, and we have the cost per unit. Correct? This is our cost per unit. If we produce 1,000 units, that's what's going to happen. Make sense?
Yes.
So now we can do this one way, we can do it the other way. Let's go with, how do you want to do it? Let's make here, if we have to produce 1,000 units, what's going to happen? If we're making 1,000 units, then how much will be my total cost?
100,000.
So my total cost for the direct total cost will be between all those four, correct?
Yes.
So what I'm gonna have direct material. This gonna fix it time $40, and I'm gonna have the rest. So 40,000 for direct material, 10,000 for the direct labor, 30,000 for the variable overhead, and 20,000 for the fixed cost, fixed overhead cost. So my total cost in this case will be
100.
all those four together, $100,000. We already know that if we make it. We already know that. Correct?
Yes.
Cool. Okay. Now let's see what's gonna happen if we buy it. If we have to buy it, what's gonna happen? Obviously, we have to pay the purchase price. How much is the purchase price?
$85,000.
So the total cost if we buy it. If we buy, we have to purchase price. Purchase, which is $85. Now I'm gonna need this $85. So I have to pay in total, since I'm buying, that will be 1,000 units here. Since I'm buying 1,000 units, this one time, that one, $85,000. Make sense? Now the question is, what else I have to pay? So it's estimated that 10% of the fixed overhead costs will not longer be happening if the company buys from the outside supplier. So how much is my fixed cost right now? It's $20,000, correct?
Yes, sir.
If I buy it, 10% will disappear. What's going to happen with the 90%?
Decrease to 18%, 18,000.
So the other 90% is going to stay with me, correct? I have to pay those 90% as well. Make sense?
Yes, sir.
So how much I have to pay? That will be, sorry, that will be here. I want to put here 90%. It's going to stay with me. So in that case of the fixed cost, I'm going to pay this one time 90%. So it's going to have to pay that 18,000. So my total cost will be $103. Make sense?
Yes.
So the question is, should I go, should I make it, or should I buy it?
Make it.
Make it. Why? Because it's gonna spend only $100,000. If you buy it, you have to spend $103,000. So what's gonna happen with my income? Is gonna increase or decrease?
Decrease 3,000.
The monthly net income is gonna decrease with $3,000. So now, if you have to do it in the Wiley way, the Wiley way is gonna show you. Let me see if I can easily make it. So that will be still make this one. So now we have to change the formula. That will be this one time that one. This is if I make it. Now, if I buy it, I need to insert a new column, and that will be buy here. And if I buy it, that will be zero, that will be zero, that will be zero. And from this one is going to be only 90%. That will be 18,000 here. And the last thing that left is the purchase price, right? I have to pay the purchase price 85. Most likely we need to do here a new column if we have to use it this way. Or yeah, I can do it this way. So direct material, I can flip here the unit, cost per unit. And then there will be another cost with another column. There should be another column here for the percentage. Insert on the, let's move it right side. It's too many movements. One column, I want to move it. Trying to make it more useful for you. Sorry, just improvising at the moment. This, and then we're gonna have here the percentage by is $85. $85, and let's make it the same format like the other one. And the fixed cost is 90% stays with me if we have to do it. Okay, that's give me more comfort, and the number of units is here 1000, and here will be 1000 units as well. And now I can start plugging the information and get the calculation. So that will be this one and that one. It's going to give us the numbers. And then to buy it, obviously, that will be 0 here, that will be 0 here, that will be 0 here, that will be equal to 20,000 times 90%, 18,000, and the last one will be this time 85,000, and then we can see the calculation at the end. We can see that this is going to cost us 100,000, this is going to cost us $103,000. So if we decide, let's move those one, format those guys here. And that will be 0, obviously. And the last column is the differences, or that our incremental analysis. And that will be if I make it, what's my cost saving? I can save this one minus that one. That will be my cost saving. Cost savings. Make sense? Do you guys understand this logic? If I
Yes.
buy it, I'm gonna save $40,000.
Yes.
If I buy it, I'm gonna save $10,000. If I buy it, I'm gonna save another $30,000. If I buy it, I'm gonna save only $2,000. And if I buy it, I have to pay $85,000. So where is my bottom line? I'm gonna lose $3,000. That will be the way Wiley wants you to do this type of questions. So we're gonna have here make. Let's make it fancy. Make versus buy. And then you have the cost saving. There you go, beautiful. Cover for chart for you. And now you can see where we are, what's happening. Let's stop sharing this. Let's go back to the slides and continue with our slides. So what we decide, make it or buy it?
Make it.
Make it, because if we buy it, we're gonna decrease with $3,000.
Yes.
Now, let's see the other thing. The other decision that we have to make is to sell it or process further. At some point, you have to decide, If we have a product that I can further process it and make it something else, is it more profitable to sell it as it is, or should I process it further, increase the sales price, and sell it? Let's pretend you have an apartment to sell. The question is, if you make improvements in the kitchen, how this is going to affect the sales price, and if the increase in the sales price will be enough to cover the cost for the uh, that improvement that you're going to make in the kitchen. Make sense? That's why we are here. That's a very simple thing. So if it's processed further, the selling price will increase, obviously, but production costs also going to increase. Decision criteria is process further as long as the incremental revenue exceed the incremental cost. In other words, if right now you can sell the apartment for $100,000, that will be the starting point. But if you make improvement in the kitchen and you spend $35,000, you'll be able to sell it for $140,000. Now the question is, the incremental revenue, is it more than incremental processing cost? As long as it is, then go for it. If it's less, no go. Make sense?
Yes.
So let's see now. Any cost which happened up to the point of the further processing, any cost that you have for that apartment before the first start selling it are irrelevant. Those are sunk cost. Forget about them. There are two decision scenario here. Single product case. The company produces only one product that can be sold or processed further. Or second case scenario, multiple product. When the company produces multiple products from a single product material, those are joint products, and some of the product can be only be sold as it is, and some products may be sold or processed further and then sold. So that's what we're gonna chase here. Let's see the first one. This company manufactures single product, which is a table. Each unfinished table sells for $50. This company currently have unused capacity that can be used to process each table further and sell it as a finished table for $60 per table. Now, per cost unit information is given. So direct material is $5, direct labor is $10, variable manufacturing overhead is $6, fixed manufacturing overhead is $4. So up at this point, company generate $15 contribution margin for each unfinished table. Make sense? Now, the question is, should I go and process it further? What will be the relevant cost here? First, if I decide to move from unfinished to finished table, direct material is going to increase by $2. Direct labor is going to increase by $4. Variable overhead manufacturing costs will increase with $2.40. Fixed manufacturing overhead manufacturing cost is going to stay the same because we are the relevant range. The question is, should this company sell the table as a finish, or should the process further and sell it at $60? Let's copy this information and let's move to Excel spreadsheet and let's think about it. Just give me a second to do some modification here on the Excel spreadsheet, and I'm gonna show you this Excel spreadsheet. Okay, this is what we have as information. Let's get the beginning information with the direct material and direct labor and everything else. I'm not sure if this information is going to be um, available for us as Excel spreadsheet, but I can easily put it here. No, it's not. Okay, it doesn't matter. Can you guys see my screen?
Yes.
Yes.
Okay, so let's start. Currently, what we're doing, it cost us, direct material is $15. Direct labor, $10. Variable overhead, $6. And fixed overhead is $4. Sales price at this point unfinished.
15.
Unfinished sales price is $50. So what we're generating? We're generating contribution margin of, actually that will be direct income here in this case. It will be direct income. It's gonna be this one minus this one minus that one minus this one minus this one. Okay, we're generating $15 per unit, correct?
Yes.
That's if we have it as unfinished. But now let's finish it. What's gonna happen? If I finish it, what's gonna happen now?
Selling price going to increase.
That will
60.
be unfinished. Now the current price gonna increase. The selling price gonna increase, right? What will be the new selling price?
60.
Let's go with automatic and let's fill it this one with it. So the new selling price on the finished will be $60. New additional cost. How much will be the total cost now? If we have to add another $2 to our direct material.
70.
16.
17. If we have to add another $4 direct labor,
14.
14. If we have to another 240 on the variable overhead,
8.4.
2.4. How
8.4.
2.4, right? So let's
Eight-
move this like this. 2.4. Oh yes, 8.4.
8.4.
8.4. Fixed cost.
Same.
Nothing. $4. So where we are in this case? We're making $17 income. This is if I finish it. So based on this, should I go or should I not go?
Go.
Definitely go, right? Because we're gonna make, how much we're gonna make more?
2.
$2 more. So let's see now the difference. Let's see the incremental analysis. If we process it further, what's gonna happen? How much more income is gonna get?
Um.
Mind this one, right?
Yes.
But now I have to pay cost. How much will be my cost? Direct material minus this one. So I have to pay $2 more. I have to pay on direct labor for more doors. On the variable overhead, $2.40 more. On the fixed cost, there's no changes. So in total, where I'm gonna be? That's not the one. Yes, because that one, in this case, you have to change the formula here. Sorry, I have to change the formula. That will be like this. So where am I on the difference? Is it profitable for me?
Professor, it should be 2 or -2. Like,
Two. $2, right?
no, in terms of direct material and like direct labor is -4. So it should be positive or negative?
No, now we're chasing here the differences. Make sense? Now I'm chasing the differences. So the difference in the sales price, I'm getting $10 more. But on the direct material, I have to pay $2 more. On the direct labor, I have to pay $4 more. If variable overhead, I have to pay $240 more. You can make it positive, you can make it negative. But in this case, if you make it negative, you can see the negative is outflow, the positive is inflow. Make sense?
Yes.
That's why I decided to go that way. Because again, we're chasing what's going to increase and what's going to decrease. Understand?
Yes. Thank you, Professor.
Okay. Is it $2 or $1.60? Let's make it zeros. So we're not making $2, people. We're making only $1.60. Sorry. Sorry for the disappointment. We 40 cents less. Make sense? Can you see it?
Yes.
So the bottom line is, shall we go and finish those tables?
Yes, sir.
Yes. Why? Because we're going to get $1.60 per table more. So now let's go to the slides and see how our slides dealing with this. Let me share my screen. So once we have this, the while is going to ask you to do this. If we're doing this, if you're selling it as it is, this is how much you're going to get. If you process further, that will be the new cost. So the incremental analysis is the difference is in the sales price, you're going to get $10 more, but you have to pay $2 more for direct material, $4 more on direct labor, 2.40 on the variable overhead, and 0 on the fixed overhead. Total, you have to pay $8.40 more, but that leaves you $1.60 out of the $10 that you get in increase. So yes, go for it. Now, if we have to do this with the multiple products, now we're going to apply when the multiple products are produced simultaneously from the single product. That will be referred to as a joint products, and products become identifiable from each other at the split-off point. Cost before the split-off point is not relevant. That's a sunk cost. So that's not going to affect our decision, should I process further or should I sell it as it is. Now, the example here for the single product that can be split on the joint body products, which you call joint products, will be petroleum. If you have petroleum, from the petroleum you can make a gasoline, you can make lubrication oil, you can make a kerosene. With the meat, you can sell it as it is, or you can make hides, you can sell it as a bones. Dairy, you can sell it as a milk, but you can make whole milk, you can make skim milk, you can make ice cream. The question is, which one of those should I process further? Same decision criteria. Decision criteria is process further as long as incremental revenue exceed incremental processing cost. What's the incremental revenue in our case? The additional sales price that we're getting. As long as the additional sales price is more than the additional cost, go for it. Let's see the chart here. Raw material goes through the common process, and the joint costs happen in the common process are not relevant again for the decision making here. So how it's going to be? We have this raw material, which is milk. Common process. At the common process, we split it on the cream or skim milk. Now, cream, I can sell it as it is, but I can process it further and I can get the cottage cheese and then sell it. Skim milk, the same. Skim milk, I can sell it as skim milk or process it further and make condensed milk and then sell it. Cream and the skim milk are the joint products. Why? Because they're coming together from the raw milk. Now, the total joint costs are 14,000 allocated to the main product. For the cream, we have 9,000. For the skim milk, we have 5,000. Additional processing cost for the cottage cheese is 10,000. For the condensed milk is 8,000. Now, what we need is the selling price. The first decision is whether to sell or not will be for the cream. Now, if we sell it as it is, it's going to cost us $19,000. We're going to get $19,000 if we sell it as it is. If we process it further, we're going to get 27. So we get additional $8,000. But as we already saw, if we're moving from the cream to the cottage cheese, it's going to cost us $10,000. So should I process it as a sell it as a cottage cheese, or should I sell it as it is as a cream? What would you say?
Sell it as it is.
As it is. Why? Because if you go with the cottage cheese, you actually going to lose $2,000.
Yes.
The cost to make it is $10,000, but you're going to get additional only $8,000. So you're losing $2,000. So sell it as it is. The other one, the skim milk. Now, skim milk, I can process it and make condensed milk. If I make a condensed milk, it's going to cost me $8,000. Now, let's see how much more I can sell it. For the condensed milk, is it that condensed milk? That's the first, that's the second, that's still the second condensed milk. Condensed milk, at this point, I can sell it for $11,000. If I process it further, I can sell it to 26. So the additional revenue that's going to generate is $15,000. But it's going to cost me only $8,000 to make it. So should I process further?
Yes.
Yes. Why? Because I'm going to get $7,000 more. If I'm selling it, I'm getting only 11. If I process further, I'm going to get 18, which is $7,000 more. Make sense?
Yes.
So let's do now. Question for you. Tell me what you think.
A.
And that should be the right answer. Yes, it is. Now let's see about this one.
D.
A.
Which one is not qualitative factor? What's a qualitative factor? What's a qualitative factor here? What will be the other factor? If we have qualitative, what's the other?
Quantitative.
Quantitative. So what means quantitative? What means qualitative?
Quantitative means numerical, and qualitative means other factors which are not numerical, like employee
Thank you.
satisfaction.
I cannot even say it better. So which one is numerical here?
D.
D.
D. Is the numerical qualitative factor?
No
Yes.
quantity.
No.
D.
So
D is the
D. Okay, Sabina got it. That's good. Let's move on now. What are we gonna do with this? Excel spreadsheet or how do you like to do with this? Talk to me, people. Do you want to do it? Do you want to try it by yourself, or you want to do it together?
Together.
Together. Let me flip it then to Excel spreadsheet. And let's see what we're gonna do there. Okay, I'm ready to share my screen and share. Can you guys see the question?
Yes.
Okay,
Yes.
what we have here? We have two products, right? We have alpha and we have
Beta.
beta. Alpha should be alpha like this and beta like that. Okay, give me the quantity. What I'm doing with alpha, what I'm doing with beta. How many kilograms I'm dealing with alpha?
20.
5.
5,000.
Kilo.
5,000 kilograms alpha, and beta, how much is the quantity there?
10,000.
10,000. Is the quantity important? It should
Yes.
be, right? Okay. So if I sell 5,000, can be split at sells a split at the split point. For how much? $20 per kilogram, correct?
Yes.
I can sell it as it is. What will be that? Sell as it is. And I can sell it for $20. But I can process it further, correct?
Yes.
Yes.
These guys all process it further for additional cost of 20,000. But I can sell it for 25. Further, if I go further, how much I can sell it?
$25.
$25. How much additional I'm gonna generate?
$5.
Additional. $5. That will be equal to this one minus that one, right? If I'm generating $5 per kilogram, how many kilograms we talking total? How many kilograms? 5,000,
Five.
right?
5,000.
So how much is my total? 25. Total additional revenue. Correct? That's how I'm gonna get total additional revenue is 25. How much is my total additional cost?
20,000.
20,000. So should I go or no go? Am I
Go.
generating something?
Yes.
How much
Yes.
we in generating?
5,000.
25 minus 20, I'm gonna generate 5,000. That will be my additional income, right?
Yes.
5,000. So are we going with this or no? Where are we making more income? Here, or if we sell it as it is, how much we're gonna make $20, but if we go further, additional cost is $5, we're gonna get additional 5,000, right? So selling as it is or going further?
Going further.
Going further. That's for alpha. Let's see now beta. If we sell it as it is, how much will be?
15.
15. Okay, let's get those 15. Yeah. Further,
To 16.
we can get 16. How much additional is that?
$1.
I'm getting $1 additional. But it's so the total, how much I'm gonna get in total?
16,000.
Why 16,000? I'm selling 1,000 kilograms. How much additional I'm gonna get?
Oh, 10,000.
$10,000, right? That's dollar. Sorry, not this one. This one is dollar amount, and this one is dollar amount, and this one is dollar amount, and all those three are dollar amounts. So I'm getting additional $10,000. How much I have to spend?
20,000.
20,000. Are you okay with that?
No,
No. Why?
because there's a loss.
Because we're gonna lose $10,000. So the question is, if the venture decide to process alpha beyond the split off point, what's gonna happen with the income?
Inquiry 5,000.
Increase it 5,000. Can you see it?
Yes.
If we go with beta,
Decrease 10,000.
10,000. Unless we sell it as it is. All right. Let's go back to our slides. And let's see the solution. If we go with the alpha, it's going to increase with $5,000. That will be the correct answer. Good job. Let's go now with replacing the equipment. At some point, we have to decide, should I keep this asset or should I replace it? At home, what will be that? Should I keep the old fridge or should I replace it with the new one? Should I keep the old dishwasher or should I replace it with the new one? The fact that you don't like the color of the new one, of the old one, is it a good reason to change the dishwasher? Would you replace the dishwasher because you don't like the cover?
No.
No. What we have to do? We have to find something else. So what will be that? We're gonna replace the asset if the new asset increase the net income. Now, we're not gonna consider, even though it's the capital decisions, we're not gonna consider time value of the money. And we're not gonna consider the capital cost allowance, which is for tax purposes, and we're not gonna consider income tax. Those one we're gonna forget about it. We're just gonna chase the pure cost here, nothing more. So what will be the terminology? Terminology, a little bit terminology. You already know that we have book value, which is the original cost. Which is net after accumulated depreciation. The book value is how much is the value at the asset at this moment, which will be the original cost minus the accumulated depreciation.
It's vital friend.
Sorry, what? Sunk cost will be the book value. Why? Because the original cost is. And that's not relevant for decision making. How much you paid, it doesn't matter. Salvage value, however, is the something that we have to consider. Why? Because the salvage value will be the estimated amount that we may get if we sell the old asset. The salvage value was in the previous in the beginning. We're talking like a residual value. Remember?
Yes,
And
sir.
when we have to do that, we have to add residual value. Residual value is the money that we can get if we sell the asset. Useful life is how long we're gonna expect to generate revenue from this asset. So here, what we have? We have this. This company is considering replacing one of their machine with the new machine. If the new machine is purchased, variable manufacturing overhead cost will decrease from 160 to 125 per year. And we have some other information. Now, how are we going to deal with this question? Well, obviously, I have to flip it in the Excel spreadsheet. So again, just give me a second just to organize the Excel spreadsheet. And we're going to start looking at the information and see which one is relevant, which one is not relevant, which one is valuable for us, which one is not valuable for us. Okay, let me copy this information here. How do you like these questions? Are they interesting for you or boring?
Interesting.
Interesting.
Yeah, honestly speaking, that's the part of the managerial accounting that's also very interesting for me because you have to make a decisions, right? You not only big based on the cost, but also the other you have to consider the um, qualitative side of the decision as well. So I'm ready to share my screen with you, and that will be my screen. So what we have here, we have the old machine, we have the new machine, correct? Can you
Yes.
guys see my screen?
Yes, sir.
So if we keep the old machine, what's gonna happen? Obviously, we're gonna have cost, right? What will be that? That will be the variable manufacturing overhead, manufacturing cost. If we keep the old machine, our cost will be 160,000, correct? Are you guys with me?
Yes.
Yes.
If we get the new machine, how much will be my cost?
125,000
25,000. Now, for what's the period of time?
4 years.
We're talking about 4 years. And 4 years here. Total variable cost. Variable manufacturing cost. This one time, that one, right?
Yes.
And for the new machine, that's gonna be the new cost. Okay, this is my cost. What else I have to do? I have to buy the new machine. Cost for new machine. Correct? If I keep the old machine, my cost for the new machine will be 0, right?
Yes.
But if I buy the new machine, then I have to pay
120,000.
120,000. Okay. Is there anything I can get?
Service value.
Salvage value. Now, if this is a cost, then let's put it as a negative, huh? Are you agree with me?
Yes.
Yes.
If this is a cost, let's put it as a negative. And if this is a salvage value, that means money coming in, correct?
Yes.
That will be 5,000. I'm gonna get here. Here I'm gonna get 0.
We have changed that the new machine with 5,000 and our machine with 0.
So the new machine, the old machine, I can sell it for 5,000.
With
The
our
old
machine that with
But
our
the new
machine,
machine, there's nothing, right? Is there any salvage value for the new machine?
No.
No. So I cannot get anything. So how much is my total cost? If I keep the old machine, where am I? It's gonna cost me 635,000, correct?
Yes.
If I buy the new machine, it's gonna cost me
620,000
so what's my saving?
with the new machine.
Saving. So if I keep the old machine, where is my saving? Minus that one. I have to spend, how much I have to spend? $140,000 more, correct? If I keep the old machine. But if I buy the new machine, if I keep the old machine, I'm saving 120,000 because I'm not buying the new machine, correct?
Yes.
And if I keep the old machine, I'm gonna this $5,000 that will disappear. So I'm not. If I keep the old machine, that will be 0. I'm gonna lose those 5,000. So basically, I won't be able to get those $5,000. So if I keep the old machine, 15,000. Why is 15,000? Should be 15,000, right? Here the difference is $15,000.
Yes.
Yes.
How can we make it 15? There should be 15,000. So, oh, if I keep the old machine, I can sell it. Yes, I can still sell it for $5,000 later. Right? At the end of the useful life, I can still sell it. So if I keep the old machine, I actually is gonna lose $15,000.
So can you please explain me how you got the saving for total VMC?
Total So now, watch this. If I keep the old machine, I have to pay $140,000 more. That's not saving here. I'm actually paying $140,000 more. Make sense?
Yes, sir. But is it because the new machine is lesser?
It's because watch this. If I'm staying with this situation, I'm eliminating this. So I'm comparing if I stay with this and I have the new situation, am I saving money here? If I keep the old machine, am I gonna save money?
No.
No. I have to pay $140,000 more.
Okay.
But but I don't have to pay buy the new machine. And if I keep it at the end of the useful life, I can sell it for $5,000. But now let's see if we change the perspective. Now, if I decide to let's say the if I this will be if we keep the old machine.
Professor, but the
Yes,
question says that they are considered to replace with the new machines, so
we
we should
so if we
consider.
so now we're gonna go to the other scenario. If we replace, let's go with the if we replace. What's gonna happen if we replace it? Now we're gonna generate cost savings, right?
Yes.
How much will be my cost savings?
100.
This one minus that one, right? That should be that.
100,000.
140,000 I'm saving,
Yes.
but I have to pay
120.
120. And I'm also gonna get $5,000. So how much will be my total? $15,000 saving.
Sir, we're not going to add the 5,000
That's what I'm
salvage
thinking,
value.
right? Why
Yeah.
is that? Why is that? We should add the 5,000. Yes, we should add the 5,000 because that 5,000 here, if we lose it, we're gonna go this way, and that 5,000 is gonna go that way. No, is it with the minus, and that will be plus here. 5,000. That's how it should be. That's what I was thinking. Because if I keep the old machine, I'm not gonna sell it. So if they get a new machine, if they keep the old machine, the salvage value is so I'm not gonna get this $5,000. I'm gonna get the 5,000 only and only if I get the new machine. Make sense?
Yes.
Yes,
Yes.
sir.
Yes, sir.
So that's how it's gonna be. That make more sense, isn't it? And then I can transfer this one, I can transfer that one. And that's how we get the 25,000. So if we keep the old machine, we're not gonna get the 5,000. Only if we keep the old machine, we're not gonna have 5,000. Only if we get the new machine, then we can take advantage and sell the old machine and get the $5,000. So the 5,000 is gonna reduce the cost of the new machine, not add to the saving on the old machine. Make that adjustment in your mind, please. So shall we replace it?
Yes.
Obviously, right? If we replace it, we're gonna generate $25,000 saving. If we keep it, we're gonna lose that opportunity to generate $25,000 saving. So that keeping is definitely no for us. Okay, let's go back to the slides and let's see how the slides doing it. So again, the information here, and then we're going to this chart. And this chart is if we keep the old machine, it's gonna cost us $640,000. If we replace it with the new machine, The variable cost gonna go down to 500,000. The new machine cost will be 120, and the salvage value that we can save is $5,000. In total cost will be $615. So the incremental analysis will be $140,000 saving from the variable cost. 120,000 we have to pay for the new machine, and $5,000 gonna come from the salvage value. In total, we're saving 25,000. Question for you here. What do you think about this?
Mm. So can we say it is an opportunity cost?
So question. First one, do we have to consider the salvage value of the old equipment?
Yes.
Yes. If we sell it, are we gonna get the money?
Yes.
Yes. So first of all, is this a non-incremental cost? What's a non-incremental cost? I have no idea what is the non-incremental cost, but cost that doesn't change. Is it cost at all? Is the salvage value cost?
No.
No. Is it opportunity cost?
Mm.
No.
Opportunity cost is something that we're giving up in order to get something else. Is that the case here? Salvage value? No. Cost that is not differential obviously is different, right? Because if we don't do it, we're not going to get it. If we do it, we have to get it. So now, is it a relevant cost? Well, definitely it's irrelevant. Now, the only thing
Yes.
is the salvage value. We shouldn't look at the cost. The only way you can look at the cost is if you don't sell it, if you keep the old machine, then you're losing that $5,000 opportunity. That in that case, that will be your cost, right? So for that reason, and the salvage value is going to be considered a relevant cost. It means relevant information for your decision. I wouldn't say it as a cost, but they say it a cost. Let's see this one to eliminate unprofitable product or segment. Sometimes you have to make that decision. Should I stop doing this or should I continue doing it? And that can be product or product line, can be a segment, can be division, can be a customer. Now, the decision criteria, as you can see in every of those situations that we have to make a decision, there's a decision criteria. Decision criteria will be, we're going to drop, we're going to stop producing this product as long as we improve overall situation, or in other words, we're getting net income. The key here is, let's see what the key is, the proper handling of the fixed cost. And determine which of the fixed costs is avoidable, which is unavoidable. Now, the avoidable fixed cost is the cost that no longer will be happening if we decide to get rid of the product. Unavoidable fixed cost is regardless what we're doing with the product, are we keeping it or we stop doing it, we still having that cost. So that cost will continue to be incurred regardless if you stop or not. Question for you. Imagine this, I'm a household with 2 kids. Can you picture it?
Yes.
So now I'm paying for the internet at house, which is Wi-Fi internet, everybody using it, including the kids. Now, if I get rid of the kids somehow, how this gonna reduce my internet cost? Do you think the internet cost gonna go down?
No.
No. Why? Because it's unavoidable cost. Make sense?
Yes.
But if I get rid of the kids, do I have to pay for the kids' shoes, kids' soccer practice now?
No.
No. So which one is avoidable cost?
Paying for their
Soccer practice, right?
yes.
Which one is unavoidable? Internet fee. Make sense?
Yes.
That's how we should look at this. Now, we're going to consider the effect on the related product line or segment. Fixed costs allocated to the unprofitable line or segment must be absorbed by those that remain. So the net income may decrease even unprofitable line segment is eliminated. So we have to be careful of the allocation of the fixed cost, because again, if the allocation of the fixed cost is allocated to the product line which make it look unprofitable and we decide to eliminate, we may have to keep the cost and not be able to eliminate the cost, and that's going to go against us. Decision criteria again will be remain the product line or segment unless your saving or eliminating fixed cost is greater than the loss contribution margin. So now we're going to the point that, watch this. We're talking about eliminating fixed cost are greater than loss contribution margin. Now, what that means? Means that we're having sales minus the variable cost, correct? That's going to give us contribution margin. Make sense?
Yes.
Minus the fixed cost, what's going to give us?
Income.
Net income. When the net income will be more than zero?
No.
When? When the net income is going to be more than zero?
When it is when it exceeds the break-even point.
When we see the break-even point. In other words, when my contribution margin is more
Fixed cost.
than the fixed cost, correct?
Yes.
So, if my contribution margin is more than the fixed cost and I decide to eliminate that product, what's going to happen with my income?
It's going to decrease.
It's going to decrease. But if my contribution margin is less than the fixed cost and I decide to eliminate the product, what's going to happen with my income?
You're not going to get a net loss.
I'm not going to get net loss, or my income is going to improve. Make sense? So now that's what means here. We're going to eliminate the product or segment. Unless the safe to eliminate the fixed cost, we're going to keep the product, we're going to keep the product, and we're going to eliminate it only and only if the the fixed cost that we're eliminating is more than the contribution margin. Do you understand this? Where the
Professor,
yes,
I do not understand that concept.
I understand that. So watch this. Again, that's why we're going to here. Contribution margin minus the fixed cost gonna give you net income. Make sense?
Yes.
So when the net income will be more than zero? When the contribution margin is more than the fixed cost. Correct?
Yes.
So if the contribution margin is more than the fixed cost, keep the product.
Okay.
What's gonna happen if the fixed cost is more than the contribution margin now?
Don't keep.
Don't keep means that who am I? I'm a my net income is below zero now.
Yeah, it should be negative.
Should be this one, I'm below zero. So
Okay.
what that means? Fixed cost is more than the contribution margin. If the fixed cost is more than the contribution margin, eliminate.
Okay.
Make sense?
Yes, Professor.
Great. Now let's go here. Now we have those three product lines. 1, 2, 3. Pro, Master, Champ. Total. All fixed cost will not change if the unprofitable line is dropped. So the actual fixed cost will not change, which is the fixed cost, 160,000. Shall we drop this Champ product? So now, in order to make the decision, let's get this information first, and let's flip it to that Excel spreadsheet. Now, there's a lot of work for me to do because this is not like a Excel spreadsheet, so I have to do some changes here. Just give me a second, just a little bit, and I'm gonna start working with you. Or maybe I can work with you together here. Let me stop sharing this and share my Excel spreadsheet. Can you guys see it?
Yes, sir.
So I have sales, I have variable cost, I have the contribution margin, I have the fixed cost, and I have net income, correct? And I have three. I have Pro, I have Master, and I have Champ. So where are those three? On the Pros, I have 800,000. On the Champ, I have 300,000. And on the Master, change this, format cells, number, separator. And on the Champ, I have 100,000. In total, and I have my total will be like this. Make sense? So then I have the variable cost 520, 1, 2, 3. Then I have 210, 1, 2, 3, and then I have 90,000, 1, 2, 3. And then I have my contribution margin, which is this one minus that one. And I get my contribution margins. And then I have the fixed cost. That will be my first calculation here. Then I have the fixed cost, and then that will be my second calculation here. And boom, fixed cost here is 80,000, 1, 2, 3, 50,000, 1, 2, 3, and that will be 30,000, 1, 2, 3. And where's my income is this one minus that one. Can you guys see the numbers?
Yes.
So what's happening here? We have problem with the Champ. Champ looks like he's losing money. What shall we do with the Champ? Now, the question says, let me grab the question and let me go to the slides, and the question says this. Am I sharing or stop sharing?
Sharing.
Sharing. Or the question says the actual fixed cost will not change if we eliminate that unprofitable product. So what's going to happen? If that actually happens, what's going to happen? Now, this number is not going to change. We're eliminating champ. That's going to be 0. That's going to be 0. Correct?
Yes.
Yes, sir.
And we're not eliminating those ones. So basically, this is going to be 160,000. Make sense? So where's my income in this case? 370 minus 160.
Decrease.
Do you understand this?
Yes, sir.
So where's my income now? Which one
Income.
is better? This one or this one?
The
220,000.
previous one.
The previous one. So
Yes.
should I eliminate the champ?
No.
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 I should not allocate the fixed cost to the champ because again, I shouldn't be allocating cost which cannot be avoided. If those 30,000 can be avoided, then yes, they should be allocated for the champ. But if they cannot be avoided, then it doesn't make sense. Because now it looks like if I eliminate the champ, I'm going to make money. But if I eliminate the champ, I'm actually not saving anything on those 160. So I'm actually going to lose those $10,000 contribution margin that's coming from the champ. Make sense?
Yes, Professor.
Yes, sir. So
So let's, yes.
in a question, will they say whether the fixed cost will be same or will it reduce? Like,
Yes, in the question, it's always going to stay. It's always going to say.
okay, sir.
Yes. You don't have to make a guess for this. The question is going to tell you. So let's see. Let's do one question. Let's go with the question here. So let's going to happen if we eliminate the champ. As you can see, the $160,000 stays. Now we have new allocation between pro and master of the $160,000. So basically, if we decide to eliminate the champ, our income is gonna drop down with 10,000. So don't do it. So this will be another way that Wiley is gonna ask you to do it. So basically, if you continue with the champ, that's gonna happen. If we eliminate the champ, fixed cost will disappear. Sorry, fixed cost gonna stay. Sales gonna disappear. Variable cost gonna disappear. Contribution margin is gonna disappear, but the fixed cost gonna stay. So in reality, you're losing the sales, you're saving on the variable cost, but you're losing $10,000 on the contribution margin. Now watch this. The contribution margin loss is more than the fixed cost saving. So you're losing money. Make sense? So in which scenario here we are? Are we on this scenario or we are on this scenario?
The first one.
The first one, right? Because if I lose that contribution margin, which is more than the fixed cost, I'm losing income. But if I lose contribution margin, which is less than the fixed cost, I'm gonna add income. Why? Because my fixed cost savings will be more than the contribution margin lost. Let's see if there's example with this. Tell me what should I do here. Can you guys see my screen?
Yes.
Yes, Professor.
What do you think?
B, Professor.
B, because they're unavoidable. If I cannot avoid it, I shouldn't be considered. They're not relevant.
Yes.
So let's do this question. Let me copy this one and move to the Excel spreadsheet and do it there. And I believe this one will be Excel spreadsheet, so that table is going to be a way more easier here for me to manipulate it. Let's see if that's the case. Yes. Okay. Just give me a second and I'll be right with you. Okay, let's share my screen. So, this one manufactures and sells two items, product A, product B. The company considered dropping product B and expected that sales of the product A will increase with 30%. If the product B is dropped, the fixed cost of 2000 will be avoided. And we have the income statement. So what's going to happen if we eliminate product B? Let's eliminate it. So product B gone, right? That will be 0. And that will be 0. And that will be 0. Contribution margin gone. Fixed cost, we'll see. And the income like this. Make sense?
Yes.
Yes.
No. Fixed cost is that one, and this one is gonna be this one minus that one. Okay. Now what's happening now? If you eliminate the product B, expected that the sales of product A will increase with 30%. So what's gonna happen? Sales price gonna increase, right?
Yes.
With how much?
13,000.
30%, right?
Yes.
So what's gonna be? New one will be this one time 1.3.
3.
But my
Same.
direct material is gonna go up too, right?
Yes.
That's gonna be this one time 1.3. And direct labor is gonna go up.
Yes.
This one time 1.3. Okay, so now we have the contribution margin. Now what's gonna happen with the fixed cost?
We added to 2,700.
So we're gonna add the 2,700.
Yes, because 2,000 we avoided.
So hold on a second now. So right now we are right here, correct? That's where we are. So now let's figure out our fixed cost. What's happened with the fixed cost? Fixed cost originally was 6,000. But if we drop the product B, the fixed cost, 2,000 of those 6,000 is going to be avoided. How much will be my fixed cost now?
4,000.
This one minus 2,000. 4,000. Where am I? Better or worse?
Worse.
Should I go for it or no?
No, sir.
No. Currently, I'm making 4,300. If I do that, I'm gonna go down with 3,150. Do you want to lose that? How much we're losing? This one minus that one. We're losing $1,050, $150. Do you want to lose them? It's your choice. You have opportunity to lose them. So let's see the slides. So what's going to happen? What is our answer? Do we have it as answer?
Yes.
Yes. D. Okay, that's exactly what's going to happen. We're going to decrease by 150. Now let's see allocate the limited resources. Now, the tricky part here is you're always going to have some limitation and some unlimited resources. The question is how we're going to deal with those limited resources. We may have input limited resources. We may have some restriction on the raw material, direct labor, machinery capacity, anything like that. So you have to decide which product to make or sell to minimize the net income when you're dealing with the limited resource. Now, the decision criteria here is to select the product or product combination which give you the maximum possible net income. How are we going to do that? Well, in this case, if we produce two different phone cases, standard and deluxe, and we have a limited 3,600 machine hours per month, and we have this thing, this information, what should we do? Let's grab the information and move to the Excel spreadsheet again, and let's see what we're gonna do there. Okay, I'm gonna grab this table. Luckily, this one will be as Excel spreadsheet, so I don't have to do any modification here. Okay, I have it available. I'm sharing this and next share my Excel spreadsheet. Can you guys see it?
Yes, Professor.
Yes.
So now we have those two, and then we have a limited resource, which is machine hours. And we have the contribution margin, which is right here. Now, what's the key here? So far, based on the contribution margin and contribution margin only, which one is our profitable product? Deluxe or standard?
Deluxe.
Deluxe. That's with number one, and that's number two. No questions about it. But we have a limit. We have a limited resource. Which is the limited resource? Machine hours. So what we have to find out? If we have a limited resource, we have to find out what's the contribution margin within the limited resource. Make sense?
Yes, sir.
How much is the contribution margin per machine hour here?
0.4.
No, watch this. To make one unit, I need 0.4 hours.
Yeah.
The question is, within 1 hour, how many units I can produce? Or how much is my contribution margin per machine hour?
Um, so can we say 3,600 into 4, 0.4?
That will be one way to do it, but the easiest way will be, what's my contribution margin per unit within the limited resource? In other way, how much is my contribution margin per machine hour? How am I going to get it? $8 divided by 0.4, right?
Oh, yeah.
How much is my contribution margin per unit in this case?
$20.
$20. How much is here? $30. So which one is my more profitable product? Product one or product two?
Product 2.
Product two. So which product should I focus on? Product one
Standard.
or product two? On the
Product.
standard. Because that's going to give me more income within the limited resource. Make sense?
Yes, Professor.
Yes.
That in this case, that I know that the thing that you have said, but if we do the example or exercise like this, can we do that? Maybe it will be a 3,600 divided to 0.4, so that we have the total units if we spend all the limited resource to one product, and we close to the contribution margin per unit, so that we will have the total contribution margin. And which one is higher? That's one we will focus to.
That will be the too difficult way to do it in this case, because usually the question is going to tell you, it's going to ask you, going to give you demand, and the demand is not going to be related to 3,600 hours. So in that case, the way you're going, it makes sense, but then you're focusing only on one product. The question is, before you focus on one product, you to find which product is more profitable. So the question, in that case, the easiest way is you to calculate the contribution margin per unit within the limited resource, and whichever product give you that contribution margin per unit within the limited resource. So you're chasing the contribution margin per hour here. And once you find the contribution margin per hour, you're right there. Right?
Okay.
You don't have to go, it's a too long way to you to do it. Right? Run the calculation and see if you can get the $20 per product. If you get it, then go for it. But again, it will be too much exercise.
Okay, Professor.
Okay? You can get the same number faster.
Yes.
Right? That's the whole point. You to get it faster. So once we get this, once we calculate that one, we're gonna get the contribution margin per limited resource, and then we're gonna focus on the product that give you the highest contribution margin. The short-term decision, focus on the product that give you the greater contribution margin within the limited resource. Long-term, then can I reduce the constraints, or can I find something else that's gonna limit my constraint? So in this case, if we increase the machine capacity from 3,600 to 4,200, what's going to happen? Well, that's going to happen that if we produce the standard case that much in the deluxe case, we're going to get that contribution margin of $30,000 in this case. Now, the incremental theory constraints is the approach is used to identify and to manage the constraints. So first you have to identify the constraints, and second you have to continue attempt to reduce, eliminate the constraints. Let's see what you think about this. And there's one more question and we're done for today.
C, Professor.
C will be the right one, and the last one that left is this one. So we have to produce various goods and has a limited number of machine hours available. The following data apply: sales price per unit, variable cost per unit, machine hours, time to produce 1 unit. Management is deciding whether to limit the production or focus on other products. Which of the following amount should be management focus when they're making their decision? Obviously, they have to figure out how much is the contribution margin within the machine hours.
Yes.
So what's our regular contribution margin?
Sale price minus to variable cost will
Sale
be
price minus the variable cost, which will be 9.60 minus 6.20. But that's going to give us
3.4.
3.4.
3.4. But that's not the number that we're chasing, right? 3.4 divided by 4 is the one that we want.
A.
0.85.
0.85. So this will be the correct answer. Make sense?
Yes.
So when we have this limited resource, always chase the contribution margin within the limited resource. And that concludes this chapter. Now, for you, quiz next week. Okay? For you, quiz next week. Listen carefully now. I know it's the end of our meeting today, but let's make it valuable now. For next quiz, you're gonna have 4 questions. I'm telling you right in the beginning, you're gonna have 4 questions. One question will be, I need you to calculate me direct material, direct labor, and manufacturing overhead by having information about the conversion cost and product cost and some other costs. So there's a slide on that one on chapter, I believe, the second chapter that we did, or the first chapter that we did after the financial reporting. So check that one on week 4. You have that one as a slide. Next thing that I want you to do is focus on the value chain and know what the value chain is. That's not going to be question. Now the second question will be related to the internal control. So what I need to is you to identify based on the scenario. They're going to be given scenario, and I'm going to tell you exactly which one is violated. So I want you to explain what's the opportunity for fraud. So I want you to look forward, and if that's the case and this person is in this situation, how he can damage the company. So I want your creativity rather than pure knowledge here. And the other thing is, once you figure out what will be damages that person can do on the company, I want you to recommend how
আমি
can I
নিজে ইউজ করি আপনার বিশেষ না হলে একটা প্যারাফ্রেজিং করে চেক করুন
I have no idea what's that.
ইয়েস না
Is it for me that or no? Let's mute this one. Okay, so again, I want you to explain what's the opportunity for fraud here, and then how to eliminate that opportunity. And the third question will be, I want you to know how to calculate the break-even and to explain break-even. So for the break-even, you definitely need the fixed cost, and depends, is it the number of units, either total sales. For the number of units, you need the contribution margin per unit. For the total sales, you need the contribution margin ratio. So make sure how to get the fixed cost, how to get the contribution margin ratio, how to get the contribution margin per unit. And depends what the question asks you. I want you to calculate the break-even and know how to explain the break-even, please. That's question 3, and question 4 will be high and low method. On the high and low method, you have a separate recording with a separate Excel spreadsheet, so please make yourself comfortable with that one and know what the fixed cost is, know what the variable cost is. And that will be your quiz next week.
So this will be again on pen paper, right?
Sorry?
This will be again for pen paper.
What do you mean?
Means this quiz will be on pen paper. You will provide
Yes.
us the paper and calculator, everything.
Yes, I'm gonna give you the
Okay.
calculator. I'm gonna give you everything. The quiz not gonna start at 8 o'clock as usual. It's gonna start around 9.
Okay.
I'm gonna do some lecturing before, and then we're gonna start when I have all of you in the classroom. Then I'm gonna give you the quiz.
Okay,
So,
Professor.
the last thing that left is I won't be able to give you any help on the assignments because the time running away, unless you want me to. But it will be your call at this point because I know some of you have to run for the other courses. So if some of you want to stay and want to see something on the assignments, let me know. I can stay a little bit, like a 5-10 minutes more. If you don't, let's call it end of the day. You tell me, how do you feel?
Yes, Professor, we can wait.
Yes.
So for those of you who wants to go. You're gonna have the recording available anyway. So let's go then. If that's the case, let me go and check your assignment. What's in your assignment?
Professor, can we also talk about last question in the assignment, like the last one?
On the assignment from
Yeah.
this week, right?
Yeah,
Okay,
yeah.
yeah. We're gonna cover it. Just a second. That will be incremental analysis. Let me see what you have on your assignment. What's give you so much trouble? Okay, which is the question that give you? Ooh, you're spending decision making. You're spending 19 minutes on the last question. So question 6, question 7 give you trouble. Question 9 give you trouble. Let's see what's this. Okay. Let's go and do this question then. If this is the question that give you so much trouble, let's do it. Just give me a second to do some adjustments here. To make it a little bit more presentable because there's a long question. My God, this is a big question now. The last one. I'm gonna start with the last one. Is that okay?
Yes, Professor.
Okay. Let me grab the other information here about the direct material, direct labor. Okay, almost there. See what you have to do here. Okay. I'm trying to recreate this chart. Let me see if I have it somewhere, rather than recreating it. See if I have something here on my own. I don't think I have anything similar to this. But anyway, let's not spend too much time here. I'm trying to do something. Just give me a second. I'll be right with you. Almost there. Just a little patience, please. Okay, I think I'm ready. Okay, that's make versus buy, right? Is that what it is?
Yes, Professor.
Okay, let's go here. Let's see what we have. Can you guys see the screen?
Yes.
Okay, let's go with the 14. Let's make it bigger. So this company faced a number of important decisions requiring incremental analysis. One of the advantages to found the ingredient in ingenuity of owners Kevin Hope. He involvement design kayak module blah 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 has led to current design being recognized as industry leader blah 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 blah. This is blah blah blah. The ingenuity was evident in improved design. One of the most important components again is the seat. A revolution seat system, one of the kind, again, blah, 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 blah. Quality adjust the 7-lock system that allows customer seat position, maximize comfort, right? So let's go with the, having just designed a revolution seat design, current design must now, the company must now decide whether to produce the seat internally or buy them from the outside supplier. Now, the current design to produce the seat is as follow. We have direct material, we have direct labor, we have the variable overhead. Can you guys see it?
Yes,
Yes,
sir.
Professor.
Okay. Currently, we need to produce 3,500 seats. So how many seats we making? 35, right? That's the number that we're starting. That's the number of the seats that we're doing. Make sense?
Yes.
So if we make it, how much cost us direct material?
23.
$23. Direct labor,
14.
$14. Oops, that's 14. Variable overhead,
12.
$12. Fixed overhead, it's total now. So now that's the way you have to pay attention. Now here you have to decide which way you're gonna go. Am I gonna go with the total or I'm gonna stay per unit? And since the fixed overhead is in total, let's move to total. Make sense? So how much will be the total here? This one
20.
time that one. And let's fix the first one. So I don't have to drag this formula all the way. So I can easily get all those things, right? I can add the fixed overhead, which is 20,000. And what I'm gonna get? I'm gonna get my total. That's how much it cost me. Make sense?
Professor,
Yes.
how can we calculate the total? Is it multiplied by 30, 50 to 23?
This one? Yeah.
Yeah.
23 depends.
Okay.
Listen, the number of the units and number of units, right? We're not changing the number of units.
Okay.
We're producing those number of units. Total is the number of units. Let's go here, units. And units are that much. So now we're using this one to calculate the numbers,
Okay, Professor.
right? Let's use this number. Time that one. Boom. And it's gonna be the same. Only the fixed cost is fixed cost. And we're getting the total. Now we have to buy it, right? So if we buy it, what's gonna happen? 24% of the fixed cost will be avoided if the seats is purchased from the outsider. After soliciting the price of the outsider, the company determined that it will cost $51 to purchase. So what's my purchase price? 51. Correct? Are you guys with me?
Yes, sir.
So how many we purchasing?
3,050.
3,500. That's it. That's what we're purchasing. 3,500. So how much gonna cost me if I buy those 3,500?
Plus 51.
Times 51. Boom, is gonna give me this one. Make sense?
Yes.
So now, if I buy it, do I have to pay for direct material?
Yeah. No.
No. Do I have to pay for direct labor?
No.
No. Do I have to pay for the variable overhead?
No.
No. Do you have to pay for the fixed overhead?
Yes.
Yes.
How much?
24%.
24 can be avoided. How much is gonna stay with me,
Oh,
76.
right? It's gonna be 100%
Minus 24.
minus 24%.
Professor.
Oh, that's percent. Minus 24%. Yes, 76%.
yes.
So what we're gonna have? 20,000 times 76%. Boom. So how much gonna cost me? That much. So what should I do? Make it or buy it?
Make it.
Make it. Why? Because if I buy it, what's going to happen now? Or if I make it? So if I buy it, what's going to happen? If I buy it, I'm going to save on the how much
Win
I'm going to save?
70,100.
I'm going to save 7,050. Direct material, I'm saving it. Direct labor, saving it. Money, variable overhead, I'm saving. On the fixed overhead, how much I'm going to save? 4,800 only, correct?
Yes.
And I have to pay. So in total, where am I in total? Oops, I'm losing. Make sense?
Yes.
Okay. So that will be this one. Let's see what else. What other question give you trouble? What was the other one? Question. Let's see. This one. Incremental revenue. Incur cost. Question 9. Do you want me to do question 9?
Yes, Professor.
Let's go question 9. This is the question. For server. Okay. This company incur cost of 34 per unit, of which $19 is variable. To make a product with normal sales for 57. The foreign wholesaler offered to buy 5,000 at $30 each. The company will incur additional cost of $1 per unit to imprint the logo and pay for shipping. So what we're gonna do here?
First take the selling price.
So what we have to do, look at what they want. Calculate the increase or decrease in the net income, share the realized to accepting the offer, self-excess operating capacity. So what we have to do, we have to do that incremental analysis. So let's go. Sales price. How much my sales price? How much they offer me?
57.
That's normal sales price.
Oh, 30.
$30.
Okay.
Okay. $30. Right. What's my variable cost? On the
$1.
normal. On the
More.
normal.
$19.
$19. Additional variable cost.
1 per unit.
$1. How much is my total variable cost now?
20.
So total variable cost, $20. So what I'm gonna have? Here I'm gonna have the sales price. That will be those two together, right? So my sales price is $30. My variable cost is $20. So where's my contribution margin?
It's $10.
And
It's $10 contribution margin. This one minus that one. How many units I need to make? How much I'm selling? How much? How many they buying?
5,000.
5,000. So how much gonna cost me to make those 5,000? First, for how much I'm gonna get?
150,000.
150,000. How much gonna cost me?
5,000.
100,000, right? That's how much gonna cost me.
Yes.
Where am I?
50,000.
50,000. That's what you have to do. Make sense? Are you guys with me?
Yes, Professor.
Yes, sir.
Okay. Let's go with the next question. What's the next question? Let me see what you see on next question. That gives you so much trouble. Where are you on the Excel spreadsheet, right? I left you on the Excel spreadsheet. Good. Let's go to the next one. This is the next question. So let's do some each those. Can you guys see the question now?
Yes, sir.
Okay, let's go. Tell me what to do. I have to determine the incremental income or loss if I accepting this special order. What do I need? Sales price, normal sales price is
43.
43. Variable cost,
$7.
$7. What's my contribution margin on the normal sales?
43.7.
Professor, variable cost will be 10.
Variable cost, yes, is 10. 10, 33. How much my fixed cost?
It's 7.
$7.
Yep.
And that's the net income here is
26.
minus that one, which is very hard to tell because the fixed cost usually is in total. Per unit is not there. Anyway, so this wholesaler comes and tell me, can you produce this? And what I'm gonna say, I don't know yet. How much he wants to buy? How many he wants to buy? He wants to buy 9,600. How much he pays?
12.
$12. So where's my contribution margin here?
2.
$2. Are you comfortable so far with the $2 contribution margin? Is there anything else?
Fixed.
A shipping cost,
Shipping cost. How much is the shipping?
1.9 and
1.50.
50.
So if I add 1.50 costs on the contribution margin, where am I?
50 cents.
So net income here will be only
50.
this one time minus that one's gonna be how many I'm selling
9,600.
time 5, 50 cents.
40.
So do you want 4,800? Do you want 4,800?
Yes.
If you don't want them, don't do it. If you want them, go for it. Make sense?
Yes.
That's where we are. . All right, that will be increased. So, okay, this one is the, yes?
Professor, yes, on the second one, we have also the fixed cost.
Why
Seven,
do you have to consider the fixed cost when the fixed cost is
because
it's a fixed cost?
yeah, so the net income will be like negative six,
Again, what we say in the special order, are we considering the fixed cost?
but we calculate the net income.
Yeah, with it, but that's normal course of action. On what we said on special order. Special order is not the one that affect our capacity, and we're assuming that we're already above the break even. Right? When we're above the break even, is the fixed costs relevant for our decision?
Okay.
Okay, but I didn't hear the answer. When I'm above the break even, do I have to still consider the fixed cost?
Mm, no, because that
No.
point that we have fixed
We-
cost equal to contribution margin.
Right. So we already covered the fixed cost. Once we cover the fixed cost, that fixed cost is gone, right?
Yes.
So the thing is, whatever I get now is going to go directly to my income. Now, the question's always going to give you the fixed cost, but that and per unit, even though to make it even worse, I'm going to give it a fixed cost per unit. But that doesn't mean you have to consider it. Because again, don't forget, fixed cost is always in total. Per unit is irrelevant. More
Yes.
unit than producing, less the fixed cost per unit is going to go. Now the $7 fixed cost per unit is only and only because I'm producing a certain amount of units, which I don't know anyway. The question doesn't tell you. So the fixed cost chase it only in total. Per unit is irrelevant. And on the special order, when you have a special order, don't ever think about the fixed cost.
Yes.
Okay.
Yes.
So now let's go with this question. What's this question about? This question, this company manufactures golf clubs. We have 3 models. Each year, for the year of line has net loss of 10,000 from sales 217. Variable cost 150. That if the page line is eliminated, 15,000 of the fixed cost will remain. Prepare analysis show the page line should be eliminated. Okay, so let's see what's the format they want. So basically, what we're gonna have? We're gonna have sales. We're gonna have variable cost. We're gonna have contribution margin. What we're chasing? Contribution margin loss to be less than the fixed cost saved. Make sense? So if we save more on the fixed cost than we're losing on the contribution margin, go for it. If not, no. So a fixed cost, then we're gonna have fixed cost, and then we're gonna have operating net income, right? Those are the lines. How much my sales?
200.
217,000.
270. 217,123. Okay. A variable cost,
100
95,300, right? How
Yeah.
much my contribution margin? This one minus that one, right?
Yes.
21,700. Then I have the fixed costs, which are
31,900.
900. And then I'm generating loss of 10,200. Is that how much I'm losing? Yes, right? That's how the question says. We're losing that much. So now, that's what we're currently losing. If I eliminate current, eliminate. If I eliminate it, how much will be my sales?
0.
0. Variable cost,
0.
0. Contribution margin,
0.
0. How much I can save?
15,000 of fixed cost.
I can only eliminate 15,000, right?
Yes.
So 15,000 is positive for me. Okay. So I'm gonna have this one this way and this one. So where am I here?
15,000 loss.
I'm losing the contribution margin, but I'm saving on the fixed cost, right?
Yes, sir.
So now let's see what we have to do. Increase or raise the difference. If I eliminate it, I'm losing the sales, right?
Yes.
This
207.
one minus that one. Sales gone. What's happened with the variable cost? I'm gonna save on the variable cost, right? Now the sales variable cost that will be saving, it's gonna be equal to this one minus that one. So, but I'm gonna lose how much contribution margin I'm gonna lose?
21,700.
I'm losing 21,700. How much I'm saving?
15,000. Sorry.
15,000. So now that's gonna be this one minus that one, right?
Yes.
So I'm saving 16,900. So my saving, is it more or less? Which one is higher? Contribution margin loss or the fixed cost saved?
Contribution margin is
Loss.
high.
So
Yeah.
I'm losing more than I'm saving. So what should I do?
Not eliminate.
Not
the
eliminate it, right? Why? Because I'm gonna lose $4,800. Make sense?
Yes, sir.
Okay, let's see another question here. My God, so many questions, huh? And all good questions. I love those questions. So this company, what they have to do? Let's see what they have to do. Okay, what we're doing here? Can you guys see the question?
Yes, sir.
Okay, have a factory, has a factory machine with the book value of 157 and the remaining useful life of 4 years. How this is relevant for me? That's irrelevant, right? The book value, we said that's irrelevant. The new machine is available, cost of, that's now is interesting. This machine will have 4 years life. So what's the lifespan here? We're looking for 4 years. Right? The new machine will lower the annual variable manufacturing cost from 594 to 507. This is annual cost, correct? Are you guys with me?
Yes, sir.
So, how many years? Variable cost. 4 years. So if I keep the old machine, how much will be my variable cost
594,000.
per year?
Divide by 4.
Let's go per year. Keep. Let's go here. Insert per year total. How much per year? 594, 1, 2, 3. Per in total. This one time 4. If I replace new machine,
507,000 into 4.
So I'm gonna have again per year and in total, right? And I can even get those one and put it here. Now I have to check this one. C8, just gonna make it like this. Okay, and then copy, paste this one here. So that will be 507,123. So my variable cost going down, right?
Yes.
What else I have? Is there any salvage value, anything like that?
No, we
No.
have
Cost of the new machine?
nothing.
Yes.
What
Cost
if I
200.
keep it, I don't have to pay it, right?
Yes.
But if I buy the new machine, I have to pay 245, 500, and 500,
500, yeah.
right? So I'm paying that one. How much in total? This is my total here. This is my total here, correct? What's the difference?
Total cost is decreased.
What's gonna happen if I go with the new machine?
Variable cost will reduce by
How much I'm gonna make saving on the variable cost?
348,000 saving.
Right? But I have to pay it. Right? So in total, where am I?
Saving 125.
Go or no go?
Go with the new machine.
Go with the new machine. Make sense?
Yes, sir.
Okay, that's number 6, and I believe those are was the difficult. The other one is just multiple choice questions. Multiple choice question, you should be okay with us. Okay, guys. So let me do some things here. On that, that will be question 2. Let me enumerate those one. The label it in the bottom. Question 2. Question 3. Question 4. Question 5. 6. 7. So you have enough questions here. You to see which one is you can use, which one you can't. So now I expect you to have a good marks on this assignment. Again, if you have trouble, please break the information on pieces. And that's going to help you a lot. Don't try to be, how can I say? Don't try to, when you see the question, obviously, because there's a lot of information. Once you see that long questions, you're gonna start getting scared. Don't get scared. Just try to break the information piece by piece. Okay?
Professor,
Yes.
I have like one question, but not relating to this. I just curious that because in this chapter, I think the knowledge that we learn is very interesting and very practical to the business when analyzing cost and revenue.
Okay.
But we have a lot of assumption.
Yep.
They are related to other factor not trained or something like that. But in fact in the operation of the businesses, that will be a lot of complex and complicated, and so that if we either any other courses that will teach us about the when we evaluated any decision with all the factor.
Mm,
I mean that because this chapter it just a theory and knowledge, but it's just a basic knowledge. But in practical, it's so difficult, yeah, to evaluate comprehensively. So, is there any courses or we have to learn in the future if we want to have comprehensive view about the decision we have to make, because we have to count to the another factor as well. Yeah, opportunity cost and other like changing in the sales. Yeah, a lot, I think.
I don't think any other courses cover this material.
Oh,
So unfortunately, the only managerial accounting dealing with the decision making. Now you may have random questions here and there on the other courses, but they're not going to be exactly the same. Only in managerial accounting we have those decision making and which course is relevant, which course is not relevant. The only thing that I want you to understand is that what makes the thing relevant or not relevant is the cost differ between one decision and the other decision. That's the first thing. If the cost is the same between both decisions, obviously you're eliminating that cost. The other thing is try to break the cost on the variable and fixed cost. Now, when you break in the variable and fixed costs, remember this. At the end of the day, you're going to have a total amount. Now, variable cost always behave as per unit stays the same, in total changes based on the level of activity, where the fixed cost in total always stays the same per unit going down. So every time when you see variable cost per unit, that's a scam, pretty
mm,
much.
yeah.
And
So
when you see the total variable cost, that's also a scam. That means when you see total variable cost, that means you have to move directly to the variable cost per unit and then follow the level of the units that you're selling or you're buying or producing. When you see fixed cost per unit, see at what level that fixed cost per unit was calculated, move to the fixed cost in total and stay in total, regardless of the number of units that you're producing. That will be the key here, you to understand those scenarios, and you can use this information in future in your life if you want to. But again, you have to understand, you have to get more understanding and more practice on the cost, how the costs behave, on which situation which cost is relevant and which situation which cost is not relevant. What's the opportunity cost? What's the sunk cost? Right? Once you have those, which cost is avoidable? On the fixed cost, the tricky part is which one is avoidable, which one is the non-avoidable. Non-avoidable is the one that always stays. By the way, avoidable is the one that if we eliminate something, that cost is also gone. So those are the specific things. I would suggest you, if this is interesting for you, download those slides. Have in mind the decision rule under each scenarios, under each decisions. Keep it in mind and try to practice it. You have a lot of examples in your personal life that you can apply any of those decisions. Literally. The question is, can you find those examples from your personal life and can you add this information? Obviously, most of the decisions that we're making on our personal life are not based on the quantitative analysis, it's more like a qualitative analysis. Do I like this? Am I going to be happy? Do I like the color? What's the price? Oh, I can live with the price, right? We're not more on personal life. We're not so. Sometimes we're getting more emotional rather than be practical. But if you want to use this analysis in your personal life, you can find a lot of examples in your personal life that every day you're facing decision, should I buy it or should I make it? Should I pay a special price? Can I, should I replace my equipment or should I keep the old one? You're making those decisions in your personal life.
Thank you, Professor.
Thank you too. Thank you for today. I'm gonna stop here.